Welcome back to the Deep Dive, where we cut through the noise and get straight to the critical intelligence you need to navigate a hyper-accelerated world. Today we are diving deep into the AI economy, and we're starting with some, well, truly astonishing figures that I think demand our scrutiny.
They really are. The figures we're looking at, they almost redefine the scale of economic ambition. We're talking about a projected investment that could exceed $5 trillion in AI infrastructure.
$5 trillion.
Yeah.
Over the coming decade.
Exactly. And you see it in the market with companies like NVIDIA. I mean, its valuation has just surged to these historic, almost unimaginable heights.
And it's not just market hype, it's actually changing the real economy, right?
It is. Critically, our sources are showing that in just the first half of 2025, capital spending on AI infrastructure, it actually surpassed U.S. consumer spending as the main driver of economic growth.
That's incredible.
It contributed about 1.1% of overall GDP growth. That's AI moving from, a theoretical software thing to the literal engine of the economy.
And that's the sound of AI moving from the theoretical realm into concrete reality. But the speed, the sheer scale, it brings up a critical question that we have to confront today. Is this boom a sustainable, transformative revolution? Or are we just witnessing the inflation of a classic bubble, one that's just waiting for a geopolitical pin to drop?
And that's the mission.
Our mission today is to really unpack this intense and I think dangerous relationship between Wall Street hype, the very physical, very finite scarcity of high-end semiconductor chips.
The actual building blocks of this whole thing.
Exactly. And the severe geopolitical vulnerability that is currently concentrated in one single, crucial, non-replicable place.
Taiwan.
And to do this, we've pulled together a really complex stack of material. We've gone through financial reports that are dissecting these market valuations, and they're drawing some pretty uncomfortable comparisons to the dot-com era.
Back in 2001. Yeah. Exactly. And we've also reviewed these very detailed geopolitical deep dives, including some sophisticated tabletop exercise analyses, focusing really intensely on that structural weakness, the weakness that's inherent in relying so heavily on TSMC, the Taiwan's semiconductor manufacturing company, and what happens when that physical supply chain just breaks.
So it's a deep dive into this complex tapestry woven between tech, finance, and national security. And understanding how these threads connect is just essential knowledge right now. Okay, let's unpack this. So let's start at the market level. The core idea of a bubble and how we even know we might be in one. I think that needs to be crystal clear for everyone.
Right.
We define a stock market bubble as this rapid increase in asset prices, far above their genuine, measurable, intrinsic values. And we've seen this before, right? From tulip mania all the way to the Tronics boom collapse in the 60s.
And this concern over the current AI bubble, which has, just accelerated violently since late 2022, this isn't just speculative chatter. The International Monetary Fund, the IMF, has weighed in. Their managing director, Kristalina Georgieva, explicitly gave institutional weight to these claims. She directly compared the current market cycle to the dot-com bubble of 2001.
And when the IMF says that, you have to listen.
You do. Her warning was very pointed. She said a sharp market correction, maybe triggered by geopolitical instability or just a simple financial reckoning, could severely stunt global growth. And that would place this immense strain on developing economies that really rely on stable global capital flows.
That comparison to 2001 immediately raises the alarm. So let's get into the mechanics.
Yeah.
How is this potential bubble actually being created? Specifically, let's talk about this sheer concentration of wealth, what some are calling the valuation jitters.
The concentration is truly staggering, and this is a key signpost, of a potential bubble environment. Since the moment ChatGPT launched in November 2022, AI-related stocks, driven mostly by the Magnificent Seven,
All right.
they've accounted for 3/4, 75% of the S&P 500's total returns.
75%. That's not a broad market rally.
Not at all. And it gets even more remarkable. They drove 80% of the earnings growth and 90% of the capital spending growth across the entire index. This is hyper-concentrated power, and it's betting very, very heavily on a very narrow future.
And when we try to quantify this inflation, I think the most sensitive metric we should be watching is the price to earnings, the PE ratio.
Yeah, absolutely.
Because that ratio tells you exactly how many dollars investors are willing to pay today for every single dollar of future earnings a company is expected to make.
Precisely. And the gap between these AI-focused stocks and the rest of the market, That's where the alarm bells really start ringing. If you look at the PE ratio for the other 493 companies in the S&P, the entire diverse market outside the Max 7,
Yeah, the rest of the economy.
it sits at a pretty conservative number, around 15. This suggests investors are paying, what, $15 for $1 of anticipated earnings? It implies stable, almost utility-like growth.
But the AI players, they're operating on a completely different economic assumption.
A completely different planet. They are operating in a domain of projected hyper-exponential growth. Take NVIDIA. Its PE ratio has been hovering around 47.6 recently.
So investors are paying nearly $50 for $1 of future earnings.
Exactly. And other hyperscalers and key players show similar, elevated numbers. This massive gap, 47 versus 15, it's not just a difference in price. It's a profound difference in the type of growth investors are predicting. They were betting that these companies will not just grow, but fundamentally restructure the entire global economy in the next 5 years.
And that's what's needed to justify those multiples.
It is. And if that growth projection falls short, even a little, the correction is going to be incredibly painful.
And we know from history, right, that bubbles don't just inflate smoothly and then pop. They show warning signs all the way up.
Indeed. The climb itself is volatile. If we look back at the dot-com bubble, the NASDAQ went through 7 distinct surges and then falls, each of 10% or more, in the 5 years leading up to its peak in March 2000. And when that peak finally came, the crash that followed wiped out 78% of its value. We're seeing some of those nonlinear, often confusing warning signs right now.
So the enthusiasm for the tech itself, for the genuine power of AI, that might be completely justified.
It probably is, but the valuations are clearly running way, way ahead of the realized profit.
But let's challenge that for a second. Let's take the other side. If the strategists at Goldman Sachs are correct and the AI return on investment is truly compounding and sustained, well, then isn't today's 47 PE ratio going to look cheap in 5 years? Is this just, applying obsolete historical models to a truly new technological paradigm?
And that is the core optimistic counter-argument. And it's a powerful one. You can't just dismiss it. Strategists like those at Goldman Sachs, they believe this rapid valuation increase is fundamentally justified. They think it's based on the legitimate expectation of powerful and sustained profit growth, all fueled by AI's immense potential for efficiency and automation.
So they're saying the fundamentals are different this time.
They are. They argue that when you compare current large U.S. growth stock valuations, specifically the PE multiples, to the absolute extremes reached during the dot-com bubble's final year, well, the current situation actually looks modest in comparison. They believe the market is correctly pricing in the compounding economic benefit that AI is projected to deliver across all sectors.
So the big question is the timeline. Does that delivery happen on the schedule that investors expect?
That is the trillion-dollar question. It's all about the timeline.
Okay. Here's where it gets really interesting for me. Regardless of whether the growth is justified or not, the method of financing this massive infrastructure build-out, it seems to be creating this circular debt risk, a risk that acts like tinder for an eventual burst. This isn't just about high stock prices, it's about the dangerous way the money is moving.
This circularity should be triggering major alarm bells for anyone who witnessed the telecom boom in the late 1990s.
Right, I was thinking the same thing. Global crossing, Quest.
Yeah, exactly. They weren't generating huge external profits. What they were doing was essentially trading network capacity back and forth with each other, using debt and these long-term supply agreements. Company A's reported revenue was coming from Company B's debt and vice versa. It inflated the appearance of market demand and profitability.
And when the music stopped?
The revenue proved to be synthetic. It was a house of cards.
And we are seeing that exact same mechanism being applied to the AI infrastructure world right now, just swapping fiber optic cables for GPUs and data center capacity.
Precisely. We have specific documented examples of this. NVIDIA, the chip provider, invests hundreds of millions into a model company, let's say OpenAI.
Okay.
OpenAI then immediately turns around and pledges massive compute spending to a cloud infrastructure provider, say Oracle.
And Oracle needs chips to provide that compute.
So Oracle, in turn, buys highly sought-after, very expensive NVIDIA chips to build the capacity to fulfill that future contract with OpenAI. This creates a powerful debt-fueled loop. And it raises caution because the company at the end of the line, OpenAI in this case, is currently operating at a significant and accelerating loss.
So if the model company is losing money, It puts a strain on the cloud provider, which then strains the chip vendor. It's a completely interconnected risk.
That's it exactly. I mean, consider OpenAI's financial position. They had estimated cumulative losses of around $15 billion between 2023 and 2025. And the projections suggest they will incur another $28 billion in losses between 2026 and 2028.
And Oracle's building billions in infrastructure now based on revenue from that company.
Yes, they're relying on that future revenue stream, but the source of that revenue is deeply unprofitable right now. This whole circular financing model assumes that future hyper-profits will eventually materialize and cover all the debt and all the speculative spending in the meantime.
That puts a tremendous acute pressure on the entire financial chain. So what's the tipping point? What's the clear signal investors should be watching for that would tell us this circular model is about to collapse?
The key indicators are signs of severe financial distress among any of the major players, the hyperscalers, the chip designers, or the key foundation model providers. We need to watch for companies spending in a way that puts their future free cash flow generation at real immediate risk.
Like what specifically?
Specific signs would be major players suddenly cutting their dividends or their share buybacks to conserve capital, or, and this is the most critical one, piling on unsustainable amounts of debt specifically to fuel this AI infrastructure build-out. If the ability to service that debt comes into question, if a major model provider fails to hit its internal revenue targets, the collapse of that house of cards will be swift. And it won't matter how promising the underlying AI technology might theoretically be.
Okay. That deep analysis of the financial risk, that circular debt-fueled spending, it sets the stage perfectly for our next section, where we shift from the abstract world of finance to the, well, brutally physical reality of this revolution. The shift has happened, hasn't it?
Oh, it has. The power struggle for AI dominance has gone through a fundamental and, I think, irreversible paradigm shift.
Yep.
In the early years, the competition was purely academic. It was all, how smart is your model, a competition of research, algorithms, data sets.
Right.
That era is definitively over.
And now the conversation has changed completely. It's moved to physical, tangible resources. Do you have the chips to train it, the specialized data centers to house it, and the sheer electrical wattage to turn it on without crashing the grid?
Exactly. And the reason is that models decay. They're replicable. A state-of-the-art foundation model today can be matched or cloned or outpaced by a well-funded competitor in 6 to 12 months. But infrastructure compounds.
What do you mean by that?
Well, cloud infrastructure, the GPU clusters, the high-speed networking, the specialized cooling, it behaves more like a national electricity grid. It scales effortlessly, it locks in users through switching costs and network effects, and it becomes the default indispensable rails that the entire AI economy runs on.
So long-term, compounding power doesn't sit in the model layer. It sits in the physical distribution layer.
It does. The next phase of the AI revolution will be defined by millions of tons of steel and concrete, miles of copper wire, silicon wafers, and colossal gigawatts of power. It won't be defined by just lines of code sitting in a GitHub repository.
So it's the gold rush analogy refined. We're in a massive gold rush for AI. But the companies selling the shovels, the physical tools, are the ones dominating the market.
Those are the silicon merchants, primarily NVIDIA and AMD. NVIDIA, with its H100 and now the even more powerful Blackwell GPUs, is the undisputed king. Their chips are now described, and this isn't hyperbole, as the coal of the AI industrial revolution.
And coal, unlike software, is a finite, scarce manufactured resource.
Exactly. NVIDIA's market cap leap has been enormous. I mean, it's momentarily challenged giants like Apple.
And that scarcity creates powerful strategic gatekeepers.
It creates bottlenecks that dictate global industrial policy. Whoever controls the massive finite supply of these high-end GPUs, they control the pace of innovation, the cost of deployment, the barriers to entry for startups. They control the permission structure for the entire sector. Because these resources are finite and lead times for delivery stretch into years, access is everything.
And that scarcity has also been a huge opportunity for AMD, right? NVIDIA's primary challenger.
It's been a massive boon for them. AMD now offers a credible, viable alternative, and that allows the hyperscalers to diversify their supply and reduce their strategic risk. Nobody wants to be dependent on a single supplier.
Now, beyond the chips themselves, the sheer physical demand to house and power this infrastructure is a monumental undertaking. I don't think the public fully grasps this. We're talking about fundamental changes to energy consumption.
The demand for electrical wattage is enormous, and it's growing exponentially. For decades, data centers used a relatively stable 2% of total U.S. electricity consumption.
Right, efficiency gains kept pace.
They did. But that stability is gone with AI. The demand for power is now exceeding the pace of grid upgrades. Let's put this in perspective with one of the anecdotes from our sources. Meta is building a new data center complex in Louisiana. It's projected to require 5 gigawatts of power.
5 gigawatts, that's staggering.
Think about it. A single computational complex requiring the energy equivalent of powering the entire city of Los Angeles. This isn't a technical problem you can solve with software. It's a colossal infrastructural problem solvable only with concrete, transformers, massive cooling systems, and entirely new power plants.
And the chip manufacturing itself is a huge energy drain.
Huge. TSMC's energy consumption in Taiwan, driven by its expansion of 3nm and 2nm production, is projected to hit 11.7% of Taiwan's total national electricity consumption by 2028. This rapid, unprecedented demand for power is quickly becoming the ultimate physical cap on the pace of the AI revolution.
So given this massive shift to infrastructure, we have to ask the strategic question. Is it mandatory for companies to vertically integrate? Do you have to own your own hardware and data centers to win the AI race?
It certainly grants huge advantages, flexibility, massive cost control, guaranteed supply access. But it's not mandatory to win. Look at companies like Perplexity or Anthropic or even parts of OpenAI. They operate at a global scale because they optimize around proprietary data, product velocity, and really clever strategic cloud partnerships.
So they're focusing their capital elsewhere.
They are. They're focusing on the application layer and the user interface. The real competitive edge often comes from that tight feedback loop with users and fast product iteration, not simply owning the physical hardware itself.
But the people who own the rails, the cloud providers, they ultimately control the economics, even if they aren't the best model makers.
Which brings us to the critical bottleneck. As the saying goes, the electricity industry wasn't shaped by the people who made the light bulbs, it was shaped by the ones who built the grid. Cloud owners control the economics, the rules, the availability of AI compute. Model creators drive innovation, but infrastructure, by its very nature, tends toward consolidation. And that makes the hyperscalers the true long-term power brokers. The application layer might capture immense value, but it is entirely dependent on the hyperscalers' ability to deliver AI reliably and affordably.
Okay, so if the AI gold rush is fueled by speculative capital-chasing infrastructure, and that infrastructure needs cutting-edge GPUs, those GPUs inevitably lead us to one company, one geography, and one unparalleled geopolitical risk: TSMC in Taiwan.
This concentration is not an accident. It is, and this is a key phrase, dominance by design. TSMC's role in the global supply chain is just unparalleled. It manufactures almost every single advanced AI chip designed by giants like NVIDIA, AMD, and the custom silicon from Apple and Google.
And the market control numbers are just stunning.
They are. TSMC commands 65% of the world's semiconductors across all nodes. But that figure rockets up to an astonishing 92% of the world's most advanced logic chips. Those are the chips that are 10 nanometers or smaller, the ones required for modern AI training and inference.
And this isn't just a matter of who got there first. It's about a level of technological sophistication that remains, for now, non-replicable, even with unlimited funding.
That's the key point, non-replicable, at least in the short term. The technological prowess required is mind-blowing. The current leading-edge nodes, like the 3nm process, require a structure that is just 120,000th the width of a human hair.
It's hard to even comprehend that scale.
It is, and achieving this level of precision requires these massive multi-million-dollar devices called extreme ultraviolet or EUV lithography machines, and operating environments that are orders of magnitude cleaner than a hospital operating room. Precise vibration control, highly specialized water purification, and decades of accumulated institutional knowledge.
So competitors like Samsung or Intel can't just catch up by spending money.
They can't. They simply cannot achieve this level of manufacturing yield and precision at these advanced nodes right now. Replication isn't a matter of building a fab. It's a 5-year, multi-billion-dollar effort requiring a complete overhaul of an entire engineering culture.
And that dominance is secured not just by machines, but by something more human: trusted relationships and customer intimacy.
Correct. TSMC's success stems from these deeply trusted, collaborative relationships with fabless firms. Companies that design but don't manufacture, like Qualcomm, and integrated device manufacturers like Google. Fabless firms need guaranteed capacity and foundry support. TSMC gives them that, and in return, it gets to innovate new, cutting-edge processes tailored to specific customer needs.
Can you give an example of that?
Sure. We saw this deep collaboration between Qualcomm, TSMC, and Google to develop a highly customized 4-nanometer smartwatch chip. It was specifically optimized for the Google Wear operating system. This kind of co-development process creates a massive supply chain lock-in.
How so?
Because a wafer fab that's configured for a specific leading-edge product can't just be changed to make a different product quickly. It cements this global reliance on Taiwan.
And this intense global reliance has massive economic implications for Taiwan itself, reinforcing its central, albeit very vulnerable, role on the world stage.
It's Taiwan's economic superpower. The massive surge in global AI demand is directly responsible for pushing Taiwan's 2025 GDP growth forecast to a 15-year high of 7.37%. That's a huge jump from earlier projections. And this growth just underscores the leverage and strategic importance the semiconductor sector provides to Taiwan.
But that centrality comes with a critical structural weakness we touched on earlier.
Yeah.
Energy vulnerability.
Yes. Taiwan imports 96.7% of its total energy sources, all of its oil, all of its coal, all of its natural gas.
So TSMC is both the source of Taiwan's economic power and the single largest stressor on its core infrastructure and energy grid.
Precisely. TSMC is an energy giant. Its consumption hit 8.1% of Taiwan's total electricity in 2023, and that figure is projected to rise to 11.7% by 2028. This is such a critical national resource that local governments, particularly in a city like Kaohsiung where major expansions are planned, are coordinating massive infrastructure projects. Land remediation, new roads, recycled water facilities, even metro planning, all explicitly designed and prioritized around TSMC's expansion needs. This deep dependence just highlights the fragility of the entire global AI ecosystem. It all relies on continued, uninterrupted energy and resource imports into Taiwan.
All right, now we have to connect the dots. The financial bubble, the physical scarcity of chips, and the geopolitical reality brewing around Taiwan. Semiconductors have fully transcended their role as just economic inputs. They are now considered critical components of national security.
That is a new reality. Modern military capabilities, drones, precision-guided munitions, secure communications, hypersonic missiles, they are all fundamentally reliant on advanced silicon. The belief in apolitical tech has vanished. Choosing a chip architecture or a fab location is now a geopolitical act. The supply chain has become utterly and dangerously enmeshed with the accelerating U.S.-China-Taiwan rivalry.
And we are actively seeing the U.S. government try to fragment this integrated global ecosystem through massive legislation.
The S.T.H. APS Act is the big one. It authorized over $52 billion in subsidies and tax credits for domestic manufacturing, designed to reduce U.S. reliance on Asia. But it also explicitly restricts U.S. companies from investing in advanced chip manufacturing in mainland China. This regulatory volatility is rapidly reshaping the market.
And we see the direct impact on key U.S. players.
We do. Look at NVIDIA. China is a huge market for them, about 13% of their annual revenue. But they are forced by U.S. export controls to design downgraded chips specifically for the Chinese market. This tension creates these isolated demand pools and massive global supply uncertainty.
And that uncertainty ultimately translates into higher costs and supply delays for everyone else outside of China.
Absolutely. If U.S. vendors face sustained regulatory pushback or sanctions losses in the massive Chinese market, they'll naturally try to offset those losses by raising prices in more stable markets. CIOs across the globe, from Europe to Japan, are already reporting higher procurement costs and extended delays for non-sanctioned GPUs and networking gear. This geopolitical tension is a direct and immediate factor shaping every enterprise AI infrastructure plan today.
So given this tension and China's deep reliance on Taiwanese advanced chips, let's consider the most likely trigger for a global shock. The pin that could burst this AI bubble. We're not talking about a full-scale difficult invasion as the first step, are we?
No. The analysts conducting these sophisticated tabletop exercises, they identified the most likely destabilizing action China would take before 2027 as a quarantine.
The quarantine.
Yes, and this strategy is crucial because it avoids the immediate complexities and high risks of a direct military conflict, of a full-scale invasion, which would guarantee immediate U.S. intervention.
So how is a quarantine defined in this specific context?
It involves the China Coast Guard and the PLA Navy enforcing maritime and aerial interception around Taiwan. But, and this is the key part, framing it as a law enforcement operation, a customs inspection or a health check on a massive scale. The goal is disruption and energy denial, not immediate conflict. This framing minimizes the risk of direct military intervention from the U.S. or Japan, at least initially.
So crucial maritime choke points, like the Taiwan Strait, become immediately weaponized.
They do. The Taiwan Strait and the Bashi Channel to the south.
What would be the immediate crippling impact of a maritime quarantine like that on Taiwan's economy, and specifically on TSMC's operations?
The impact would be immediate and severe, because it targets Taiwan's critical vulnerability, its near-total reliance on energy imports. A quarantine targeting sea lanes would result in severe energy disruption, which would impact the highly sensitive energy-guzzling clean rooms of TSMC. It would also immediately delay the importation of necessary specialized materials, chemical precursors, gases, lithography equipment.
I imagine insurance costs would just
Skyrocket. The mere risk of this action would cause global shipping insurance costs to go through the roof, making all trade prohibitively expensive.
So the global shock of TSMC operations ceasing would be absolutely devastating. This is the moment the AI bubble, built on the promise of infinite compute, hits the concrete wall of finite physical reality.
That's the crux of the risk. If TSMC operations were to cease or even be severely degraded for just a few weeks, the world would instantly lose 41% of its high-end logic chip manufacturing capacity. This would send an economic shockwave far greater than the 2008 financial crisis, crippling every major global economy from the U.S. defense sector to the German auto industry.
And it's not a loss that's easily covered.
Not at all. Even under the most optimistic assumptions about tooling, permitting, labor, it would take the United States and its allies 2 to 5 years to build and outfit sufficient fabrication capacity to offset that loss. The delays and the sheer complexity of the build and the lack of experienced local labor.
What's fascinating here, if we connect this to the bigger picture, is that the physical quarantine might not even be the most effective long-term weapon. We often hear analysts discuss these invisible battlefields.
Yes, and modern conflict, as we saw with the Russia-Ukraine crisis, shows that the physical battleground is less than 1/3 of the total conflict. The invisible battlefields involve economic sanctions, information warfare, and critically, technology control at the software layer.
So even if a country like China could smuggle in physical chips, it wouldn't be enough.
Exactly. They could not sustain a modern, advanced manufacturing or defense industry without continuous access to industrial design software.
You mean like CAD/CAM software, the tools used to actually design the next generation of products?
Precisely. Key industrial design software, including computer-aided design and electronic design automation tools. It primarily comes from the U.S., France, Germany, and Japan. The loss of authorization for this critical software is potentially more critical to China's long-term industrial base than the loss of physical chips. You cannot design a new aircraft, a cutting-edge engine, or a next-generation chip without authorized, updated versions of this software.
So the fundamental problem, as some experts contend, isn't really technical, it's ideological.
That's the argument, that it's rooted in the fundamental value differences between certain Chinese leaders and the Western democratic world, and that manifests as geopolitical tension over the supply chain.
Okay, so we have a high-stakes financial bubble reliant on infrastructure, which is totally dependent on a single point of failure that is under severe geopolitical threat. This leads us to the crucial final section. What are the concrete solutions and mitigation strategies being employed, and what will the future market look like, assuming the worst can be avoided?
The most obvious and most expensive solution is reshoring, bringing production closer to home. The USGP Est provides these massive financial incentives for domestic investment, but meeting the expected timeline for a resilient, independent domestic supply chain is proving extremely difficult.
And we're seeing those difficulties play out publicly and expensively, even with TSMC's flagship project in the U.S.
Absolutely. The TSMC fab complex in Arizona, which is a cornerstone of the U.S. reshoring effort, has faced significant delays. Initial production of 4mm chips was expected in 2024, but that's been pushed back to 2025.
And why is that?
It's largely due to labor shortages and complex visa issues that have stalled the arrival of experienced Taiwanese engineers. These engineers are absolutely crucial for the construction, the setup, the maintenance of these highly complex, multi-billion-dollar facilities. The U.S. simply lacks sufficient domestic expertise in this niche area.
Right, that institutional knowledge we talked about.
Exactly. And we've also seen reports of culture clashes between U.S. and Taiwanese construction methodologies, which has further slowed the timeline.
And it's critical to note that TSMC is being highly strategic about which technology nodes they're willing to build abroad.
That is the ultimate indicator of their strategic intent. TSMC is keeping its newest, most sensitive technology, specifically 3nm and 2nm production, securely in Taiwan. Their overseas expansions in Japan and Germany are primarily focused on mature process nodes like 228 millimeters and 1216 millimeter.
So it's not about making H100s in Germany.
Not at all. The Japan fab, for example, is strategically located near Sony and is focused on specialized image sensors and automotive chips. It's a defensive regionalization strategy. It's not a core AI strategy. So these current regionalization efforts are vital for supply chain stability in the long term, but they will fail to address the catastrophic consequences of a Chinese quarantine for 2027. The benefits are strictly long-term.
So beyond massive government intervention, what are companies doing? What corporate resilience strategies are they using to navigate this extreme bottleneck?
Companies are employing several sophisticated strategies. They're acknowledging that geopolitics is now just a cost of doing business. One strategy is pursuing upstream control. This means either acquiring the sources or suppliers of critical materials or establishing these long-term binding contracts with raw material providers to secure access.
Okay, that makes sense.
Another key strategy is leveraging new technologies like AI and big data for real-time traceability throughout the supply chain. That allows them to quickly identify bottlenecks or diversion risks. But most importantly, corporate governance is prioritizing agility and flexibility. They're training teams to respond instantly to sudden shocks, whether it's a pandemic closing a port or a geopolitical crisis impacting component delivery.
But given that some experts argue the root problem is ideological, the solution has to be political and multilateral, not just corporate engineering.
That is the core argument for multilateral deterrence and coordination. The geopolitical reality necessitates unified action. Given the identified risk of a low-intensity Chinese quarantine framed as law enforcement, the U.S. and its allies must signal clearly and repeatedly that even such measures would be considered an act of aggression against the global economic order. Deterrence relies on consistent, multi-layered coordination with key allies in the region, like Japan and the Philippines, to maintain freedom of navigation.
And what framework is being proposed for this long-term resilience and coordination across allied powers?
The proposed solution is a strategic triad cross-platform model. It's designed to integrate military, economic, and technical resources. This model seeks to empower three distinct multilateral platforms at the same time.
Okay, what are they?
First, you have Chip 4. That's a flexible, minilateral platform designed specifically for supply chain resiliency between democratic allies, the U.S., Taiwan, South Korea, and Japan. It's about ensuring they can cover each other's vulnerabilities. Second is the Cree Way, the quadrilateral security dialogue U.S., Japan, Australia, India. That's focused more broadly on Indo-Pacific security coordination, making sure the deterrence framework is robust. And third are institutionalized bodies like the government authorities meeting on semiconductors and the World Semiconductor Council.
And what's their role?
They're vital for setting shared technical standards and regulatory frameworks, ensuring that chips produced in different allied countries are fully compatible and interchangeable during a crisis. The idea is to weave strategic, technological, and regulatory resources together to safeguard the supply chain collaboratively.
If we connect this to the bigger picture and look beyond the current bubble threat, where does the value settle in the technology stack in the long term, assuming the revolution succeeds?
Well, historically, value tends to migrate along the technology stack as complexity and costs fall. In the AI wave, the consensus view is that the initial immense profits at the infrastructure layer NVIDIA, the massive CapEx of the hyperscalers, that will eventually stabilize. And value will then move significantly to the application layer, similar to what we saw in the earlier cloud computing wave.
So once compute becomes more of a commodity,
The winners will be those who create specialized, high-utility, industry-specific applications that solve real-world problems.
so the foundational model builders and the application developers who provide demonstrable real-world utility will ultimately become the long-term winners.
Yes, but the key challenge remains economic justification. We have to remember that most investors currently struggle to justify the massive return on investment needed for the projected trillions of dollars in AI CapEx. This speculative environment relies entirely on AI delivering on its enormous economic and societal promises, widespread, massive productivity gains. And those gains remain elusive in many sectors today. The current valuation is a powerful, high-stakes bet on that future utility being realized quickly and globally.
So let's quickly summarize the complex convergence we've deep dived into today. We have a massive, debt-fueled AI investment wave that has created market valuations that are really reminiscent of historical bubbles. And it's relying on this nonlinear growth that is yet to fully materialize.
And that financial expansion is entirely reliant on the physical infrastructure specifically, the most advanced semiconductor chips, which are non-replicably concentrated in Taiwan.
And finally, that concentration is sitting directly in the crosshairs of a severe geopolitical risk, where even a low-intensity quarantine by China could trigger a global economic fallout far greater than past market crashes.
And understanding the convergence of those three forces, the fragility of finance, the physical scarcity of core components, and the inherent geopolitical risk is absolutely essential for navigating the next few years. This is not just a story about how fast a stock price moves. It's about global stability, technological control, and the structural integrity of the world economy.
Absolutely. The quest for AI dominance is driving global leaders and corporations to build physical infrastructure, those massive data centers and fabs, faster than ever before. It's leading to unprecedented capital expenditures and these staggering power demands. But considering the huge unprecedented demand for electricity, these new data centers require a single complex potentially needing the power of an entire major U.S. city. Will the AI revolution ultimately be capped? Not by the limits of software innovation or even the immediate geopolitical risk in Taiwan, but by the sheer difficulty and potentially environmental impact of finding and supplying enough clean power to run the grid. Something profound to consider as you look forward.